Alright, let's dive into something that's both fascinating and a little overwhelming: pensions. I know, pensions aren't exactly the most thrilling topic, but stick with me here. Because what I'm about to share could seriously impact how you think about your retirement. Here's the deal: in today's job market, most of us aren't staying at one company for life. We're job hopping, freelancing, and switching careers more than ever. And every time you switch jobs, there's a good chance you're leaving behind a pension pot. Sound familiar? Well, here's the kicker: those scattered pension pots could be costing you more than you realize, or they could be your ticket to a simpler, more lucrative retirement. Let's break it down. First off, let's talk about why this even matters. Personally, I think the biggest misconception about pensions is that there's something you only need to worry about when you're older. But here's the thing: the decisions you make about your pensions now, whether to consolidate them, leave them be, or ignore them entirely, can have massive implications down the line. What many people don't realize is that having multiple pension pots isn't just a hassle, it's often a financial drag. You've got fees stacking up, investments underperforming, and a ton of paperwork to keep track of. It's like having money scattered across different bank accounts, but none of them are working together to grow your wealth. Now, let's talk consolidation. The idea of combining your pensions into one pot sounds simple, right? But here's where it gets interesting. In my opinion, consolidation isn't a one-size-fits-all solution. It's not just about making your life easier, though, let's be honest, that's a huge perk. It's about maximizing your returns, minimizing fees, and setting yourself up for a retirement that actually feels secure. But here's the catch: not all pensions are created equal. If you've got a defined benefit pension, also known as a final salary pension, moving it could be a huge mistake. These pensions are like gold: they guarantee a certain income in retirement, and transferring them could cost you big time. What this really suggests is that before you make any moves, you need to understand exactly what you've got. One thing that immediately stands out is the role of fees. Fees are the silent killer of pension pots. If you're paying high annual management fees on multiple pensions, those costs add up fast. But here's the twist: workplace pensions often have lower fees because they're negotiated in bulk. So, if you're thinking about consolidating, you've got to do the math. Are the fees on your new, consolidated pension lower than what you're paying now? If not, you might be better off leaving things as they are. What makes this really interesting is that it's not just about the fees you're paying today, it's about the fees you'll pay over the next 20, 30, or even 40 years. Small differences in fees can lead to massive differences in your final pension pot. Now, let's talk about flexibility. If you're like me and you're not exactly sure what your retirement will look like, flexibility is key. Having all your pensions in one place can make it a lot easier to manage your money in retirement. For example, if you want to use flexible drawdown, where you take money out of your pension as you need it, having everything in one pot simplifies the process. But here's where it gets tricky: if you've got pensions with special benefits, like the ability to take a tax-free lump sum at 55, consolidating could mean losing those perks. From my perspective, this is where things get really personal. You've got to weigh the benefits of simplicity against the potential downsides of losing those special features. Let's take a step back and think about the bigger picture. Pensions are one of the most important tools we have for building wealth, but they're also one of the most misunderstood. If you're young, like in your 20s or 30s, consolidating small pension pots can be a no-brainer. You've got time on your side, and getting those pots working together can make a huge difference by the time you retire. But if you're closer to retirement, the calculus changes. You might want to keep those pots separate to take advantage of specific rules, like the ability to withdraw small pots early. What this really highlights is that pensions aren't just about saving money, they're about strategy. Here's a detail I find fascinating: tracing old pensions. If you've moved jobs a few times, there's a good chance you've lost track of some of your pensions. But here's the good news: there are tools and services out there to help you find them. The government's pension tracing service, for example, can help you track down old providers. And services like Gretel use your address history to find dormant accounts. Personally, I think this is one of the most underrated aspects of pension management. You could have thousands of pounds sitting in a forgotten pension pot, and you'd never know it unless you take the time to look. So, what's the bottom line? In my opinion, consolidating your pensions can be a game changer, but only if you do it right. It's about understanding what you've got, weighing the pros and cons, and making decisions that align with your long-term goals. If you're feeling overwhelmed, don't be afraid to seek advice. Yes, it'll cost you, but the peace of mind and potentially higher returns are worth it. What this really suggests is that pensions aren't just a chore, they're an opportunity. An opportunity to take control of your financial future and build a retirement that's as secure as it is fulfilling. Here's my final thought: pensions are one of those things that are easy to ignore, but they're too important to put off. Whether you're 25 or 55, taking the time to understand your pensions and make smart decisions now could be one of the best investments you ever make. So, what's your next move? Are you going to let those pension pots sit idle, or are you going to take control and make them work for you? The choice is yours.